For every £10,000 invested in the US stock market in 2023, you would have made £2,423. And thankfully for me, I was invested to the tune of over £50,000 across my public investment portfolios. One which I have on Trading212, the other on Vanguard UK, both of which now sit at a combined unrealised profit of £16,268. Now, if you aren't already invested, and if that hasn't convinced you to start investing already, then hopefully the rest of this video will do. No BS, I'll give you the cold hard facts, I'll show you the statistical data, and I'll show you some reports from some of the most reputable sources as to why you should be investing in not just 2024, but be investing for the long term too. So if that's you and you truly want to grow your wealth over time, then be sure to stick around. 2023 was a great year for investors, but here are the last 20 years worth of performance for the US stock market. 16 of those years you would have made money, or 80% of the time you could have logged into your investment portfolio at the end of each year, and the investment portfolio balance would have been higher than what it was at the start of the year. Now, when I refer to the US stock market, I'm referring to an index called the S&P 500. It's the top 500 companies in the United States of America, most of which you've probably heard of before. And historically speaking, it's provided an average rate of return to investors of 9.69% over the past 20 years, and an average rate of return of 10.5% over the past 100 years with dividends reinvested. And we'll touch upon the importance of dividends and exactly what they are in just a moment's time. But the point I'm trying to make here is that the US stock market, historically speaking, has been a pretty reliable source of investment returns. But here is a critical piece of information. Market analysis by JP Morgan shows that between 2003 and 2022, if you would have invested $10,000 in the market, it would have grown to over $64,844. But if you'd missed just the 10 best trading days in the market across all of these years, your investment returns would be cut in half to $29,708. But if you'd missed the best 40 days, well, actually your investment returns would have been negative for that whole 20-year period. So I can't highlight the importance enough that your investment returns are directly proportional to the investment decisions that you make. And staying invested into the market should be number one on your list of founding principles when it comes to investing, because failure to do so could cost you big time. Saving your money is great right now. Banks are offering a fixed rate return of upwards of 4%, and inflation globally is actually easing, with the UK inflation rate sitting at about 3.9%. But because inflation was so high last year, actually the average rate of inflation for the UK over the past 12 months is actually 7.9%. Meaning if you did not grow the value of your money by at least 7.9% last year, well, you actually became relatively poorer. So anything less than a 7.9% pay rise or a 7.9% return on your liquid assets last year actually meant that your wealth declined, despite the fact that in nominal terms, your salary or your nominal gains on your liquid assets may have actually increased. And that's because of something called inflation, which erodes the value of your money over time. In the context of the average inflation rate over the past 12 months, £100 worth of goods 12 months ago would now cost you £107.90, which perhaps doesn't seem like a lot on the surface of things, but compounded over all of your expenses over the year, which could run up into the tens of thousands, has left many people struggling financially. And now we're in a cost of living crisis. And for those a little bit higher up on the income spectrum that have a little bit more disposable income, perhaps these rates of inflation may seem somewhat manageable. But over time, regardless of where you sit on the income spectrum, inflation will hurt your pockets. Because get this, to buy £100 worth of goods in 1970, today it would cost you £1,307. In 1980, it now cost you £409. In 1990, £235, in the 2000s, £181, and just in 2010, it would now cost you £147. The average cost of goods are 47% higher now than they were back in 2010. That works out to be an inflation rate of about 3.6% per year, and as you can see from this chart, The lines in grey and red over the same period show that real pay adjusted for inflation is largely negative, meaning year on year in real terms relative to inflation, people have been taking pay cuts without even perhaps realizing, which therefore makes it so very important to choose the right investments that actually beat the rate of inflation. Because the aim of personal finance isn't just to continue to grow your nominal wealth over time, it's to grow your real wealth, which is adjusting for inflation, which is something that most people forget about. And what I'm about to explain next will certainly help you achieve that. And it will also accelerate your net worth far beyond your peers who aren't doing it. Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. It is without doubt one of the most powerful forces in the world of personal finance and investing, if you understand it. Let me give you guys two options. You can either have £1 million today and become an overnight millionaire, or I'll give you a penny today, but I'll double it every day for 30 days. Which one would you choose? Be sure to let me know down in the comment section below. Surely you'd opt for the £1,000,000 in cash, right? Well, if you did, that would be fine because you'd become rich overnight, but you'd probably be kicking yourself because after 30 days, that penny that doubled in value every day would actually be worth £5.3 million. You would have 5 times the amount of money thanks to the power of compound interest. It's the difference between linear growth, assuming that you save that £1 million for the whole duration of the 30 days, getting a small amount of interest from your bank, versus the exponential growth that's experienced from your money doubling in value. Now, of course, investing your money in the stock market isn't quite that easy. And of course, returns of that scale certainly aren't available, or at least not in the span of 30 days. Now, applied to an example in the case of investing into the stock market with amounts that are perhaps more realistic, if let's say you invested £500 a month, making additions covering inflation at 3%, for 20 years at a rate of 9.6% per year, you'd end up with £445,860. But if you stayed invested for 30 years, you'd have 1.3 million. And if you stayed invested for 40 years, you'd have £3.8 million. That is the true power of compound interest, which is a function of time, value, and returns. If you can be patient, make enough contributions, and market returns are relatively sound, you will, without doubt, be in a far greater financial position than every single one of your peers the longer that time goes on. For those of you newer to investing, it's worthwhile me saying at this point that market returns obviously fluctuate. I've quoted the returns of the S&P 500 as an example over the past couple of decades. And in 2023, the S&P 500 returned 24.23% to investors. But for completeness, here are a list of common indexes that you also could have invested in and the returns of them. Now, of course, there are thousands of investment products out there and even more thousands of individual companies that you could potentially invest into. And the investment returns absolutely differ across all of them. So whatever you go on to invest into, be sure to do your research first. Because as Warren Buffett said, never invest into a business that you don't understand. Capital growth is only one part of the real wealth equation. Passive income is the other part, and for some investors is just as important. With some, but not all investments, you'll be able to find something called a dividend yield. This is how much a company, or indeed an investment fund, pays out to investors in dividends relative to its share price. You can find out exactly what a dividend yield is by going onto websites like Yahoo Finance, typing in the name of a company, navigate over to the statistics tab, and you'll find the dividend details and a whole lot more information, which is probably for another video. If, however, you're investing into an investment fund, Vanguard UK is probably one of the most common ones. And on their website, you'll be able to find it in the fund details, usually under the distributions. So a dividend is from the profits which a company generates, which are distributed back to their shareholders, and are as pretty much as close to it comes to the true definition of passive income. With the higher the dividend yield, the more money that you'll be paid in dividends for every share in the company that you own. Here are a list of examples of how much you'd receive in dividends for having £10,000 invested in that company. You'll be able to see that some generate more than others, but do be sure to go on to do your own research on the dividend payers that you invest in. And an extra tip, if you're currently in the build phase of your investment portfolio and perhaps are a little bit earlier on in your investment journey, then you may want to consider reinvesting those dividends too. Remember what I said about compound interest? Well, that only accelerates quicker when you add your 2, 3, 4% dividend yields back into the pot too. So much so that this really interesting chart by Charles Schwab shows the impact of dividends reinvested between 1990 and 2022 on a $100,000 investment in the S&P 500. It highlights that from reinvesting your dividends, your portfolio value would be £2.15 million, roughly double the value of your portfolio from an investor who spent their dividend payments each time they hit their investment account. It's the equivalent to putting lighter fuel on a fire that will blow up your investment portfolio whilst the power of compounding works its magic. We're taxed on absolutely everything. Income tax, council tax, value-added tax, capital gains tax, inheritance tax. The government just want to suck you dry. However, investing is one of the only places that the government allows you to put your money that has tax incentives attached to it. Yes, you did hear me correctly. If you're new to this, there is something called a stocks and shares ISA, which allows you to invest up to £20,000 per tax year at the point of recording this video, absolutely tax-free, meaning the government can charge you £0 and 0 pence for any capital gains that you make in that investment account, or from any of the income that you can generate from dividend payments that are made to you. Another tax-efficient way to save your money for later on down the road is to actually contribute to your employee pension scheme. Now, as at the statistics in 2021, about 79% of Brits were actually enrolled in their employee pension scheme, which is great because it means that you and your employer can make contributions before the government take their slice of tax. So it's a tax-efficient way to maximize your pounds and pence and get that money working for you before the government charges you income tax. But the truth is, just over a third of Brits are actively investing. Meaning, if my maths is correct, over 60% of people aren't. The lion's share of people here in the UK will be financially sinking over the long run. Their money will be eroded by the silent killer known as inflation, and their salaries will not be enough to afford a comfortable retirement. Now, I've been investing for just over 6.5 years now, and I'm on a mission to encourage as many people as I can to start investing to reap the financial rewards from doing so. It's empowered me to make better financial decisions, and I've already started to see the results across both my stock investment portfolio and my recently acquired property investment portfolio too. So don't be the person that gets left behind financially. Start doing your research, educate yourself around the topic, and I guarantee your future self will thank you for it. Now, YouTube also thinks your future self will thank you for watching this video next, and with that being said, I'll see you over in the next one.